Good morning. How lease escalations protect commercial real estate investors. And if you own commercial real estate in Houston, Katy, or Fulshear, your lease structure may matter more than your purchase price. And many investors focus heavily on cap rate and their acquisition basis, but seasoned CRE owners understand something a little deeper. And lease escalations are really what protects your long term value. So let's break this concept down a little more clearly today. What is a lease escalation? Well, a lease escalation is basically a contractual rent increase that's built into a commercial lease agreement. Say at the end of the year, end of every couple of years. So instead of rent staying flat for 5 to 10 years, it increases annually based on one of the following structures. Fixed annual increases, say 2 to 3%, could be CPI based escalations, which are really inflation index escalations, or just step ups every few years. And operating expense pass through increases through the triple net structure as well. So for investors, this is not just rent growth, it's value protection. So let's look at why lease escalations matter in commercial real estate. First reason is their protection against inflation. And if inflation runs 3 to 5% and your rent stays flat, your real income is declining, is the point. And those escalations preserve your purchasing power. So in Houston's dynamic growth corridors like FM 1463 and West Katy, inflation protection matters even more because operating expenses, insurance, and property taxes are all rising in costs. Two is it's a directly impact on your property value. So commercial real estate value is driven by your net operating income. And that value is your net operating income divided by a cap rate. And if your NOI increases due to the built-in rent escalations, your property value rises, even if cap rates remain flat. So let's take a look at an example. Year one's NOI is 500,000, and at a 6.5% cap rate, that's a value of about 7.69 million. Now, if your NOI grows to 550,000 due to escalations, with the same cap, your value is now 8.46 million. And that's a $770,000 increase without changing the cap rate. Three, it improves your refinancing position. So lenders look at your debt service coverage ratio as the main metric, but also the debt yield and the stability of your cash flow. And properties with structured escalations demonstrate a little bit more predictable revenue growth, but also inflation adjusted income. And that gives you a little lower refinance risk because your income's growing with inflation. And in tighter credit environments, this becomes more critical, is the point. Four, it enhances your 1031 exit strategy. And for 1031 exchange buyers, stabilized assets with annual escalations are attractive because they provide predictable inflation adjusted cash flow. And they're going to reduce your operational risk, but they also support higher valuations at resale. And in growth markets like Katy and Fulshear, this creates competitive bidding dynamics for well-structured leases. So let's look at some types of lease escalation structures. You have your fixed percentage increases, and that's a little more common in retail and industrial. For example, say 3% annually. And it's simple, predictable, and lender friendly. But there's also CPI-based escalations, which are tied to inflation and protects against unexpected macroeconomic shifts. There's also step-up increases. So rent jumps up at set intervals. This is more common in medical office and longer-term corporate leases. There could be triple net expense escalations. So tenant pays increases in the property tax share, in the insurance, or the CAM expenses. And what this does is it shifts risk from the landlord to the tenant. Now let's look about what happens when escalations are weak. So say you have flat rent for 10 years. And the point is that's a risk. And even strong tenants become value destructive if lease terms do not adjust for the economic realities. And this is especially relevant in office and older retail assets where outdated leases can suppress your NOI growth. So let's look at some strategic takeaways for investors. And if you are considering buying a retail strip center or acquiring an industrial flex space for your business or developing pads in master plans communities or holding medical office in West Houston, you must evaluate escalation language before evaluating cap rates. Now, the lease structure determines long-term wealth creation. And along with that, here's our final thought for the day. Cap rates tell you what you're buying, and lease escalations determine what you're building. And in today's environment of inflation, volatility, as well as tighter lending standards, structured rent growth is not optional. It's protective armor for your equity. And if you want help analyzing lease structures in Katy, Fulshear, or West Houston, let's talk about strategy before your next acquisition. My name is Bill Rapp. You can visit my website, HoustonRealEstateBrokerage.com, to figure out how to get a hold of me. Love to talk to you more. Take care.